Welcome to another video in our Taking Care of Business series. In this video, I'm going to address the 5 things every investor needs to know about buying an investment property and negative gearing. Let me start by saying that buying an investment property in this country is incredibly common. In fact, up to 30% of residential properties are owned by investors, but it's not a get-rich-quick scheme. So, what are the key ingredients of negative gearing? Firstly, the right property in the right location. The entire strategy hinges on the property growing in value, and this graph highlights the difference between a property that grows at a rate of 5% versus a property that grows at a rate of 10% per annum over a 10-year holding period. The difference in value is several $100,000. As accountants, we don't profess to be property experts, but clearly some suburbs and cities produce better returns than others. You need to be wary of the property sprockers who promise huge returns on the Gold Coast and their sales gimmicks like rental guarantees and incentives like furniture fit-outs. Of course, location is only one part of the equation because you then need to decide on the type of property: a unit, a flat, or a house, 1 bedroom or 2 bedrooms, with or without a balcony, and a car space. Do you buy an off-the-plan property or an established property? Secondly, because negative gearing is a tax-effective strategy, you need to make sure the property is owned in the correct structure. For example, it could be in joint names, a self-managed super fund, or in a trust. In choosing a structure, you need to consider a whole range of issues including other income and the future earning potential of the investors. It is a critical decision, and while owning property in a self-managed super fund is flavor of the month, there are a number of issues to consider before you go down that pathway. The next item on the list is the right loan. Should it be an interest-only loan or a principal and interest loan? Should the loan be at a fixed rate or variable rate? There are numerous options, but a poorly structured loan can reduce your repayment flexibility, increase your risk profile, and create tax headaches. Often, the loan with the cheapest interest rate may not be the most appropriate for your circumstances because it lacks key features you might want down the track. Too often, investors consolidate their investment property loan with their home loan, which can jeopardize the tax deductibility of the interest. The clear message here is seek advice. The next consideration is cash flow. Negative gearing implies that each year you make a loss for tax purposes, so you need to fund the shortfall between rent and outgoings from other income sources like your wages or business profits. Remember, the profit on the investment is generally only realized on sale. We use a software program to analyze the tax consequences of buying an investment property, and it generates a 10-year forecast of cash flow, taxable income, and equity. This tool is invaluable when comparing alternative investments and will help you make an informed buying decision. We have already mentioned the importance of the right location, property type, tax structure, and loan, but there's another key ingredient: the right advice. This includes appropriate insurances and record keeping. This country now has a property investment industry full of self-proclaimed property gurus, but there is no substitute for independent, unbiased professional advice. In summary, over the years, we have assisted hundreds of clients to buy an investment property, and negative gearing has become a real niche area within our firm. We have also developed a number of practical tools and checklists, including the complete guide to buying a negatively geared property, which is available from our offices, and the rental property schedule, which you can download from the links and forms section of our website. Until next time.